All right, folks, we've got two more to go today. And our last keynote presentation of the day is by a gentleman no other than Onar Serrano. I'm so glad to hear in the chat and throughout the day that you've got so much value out of it so far. But don't go anywhere, as of course we've got this great presentation coming right up. Our next keynote presentation, oh, Victoria, yes, of course, it has been very insightful. As I said, it's by award-winning mortgage broker and avid entrepreneur, Onar Serrano. And today he'll be speaking on how to get your personal finances in shape to grow, something I'm sure we definitely could benefit from at times, especially like these. Ladies and gentlemen, Onar Serrano.
How's everyone? Thank you for the introduction. So I think I'll go into it. It's funny, you guys were talking about payment terms, and I was just thinking, how does that apply to me? Because I technically don't charge my clients, the banks pay me, so payment terms is going to be a bit weird for me. Thank you for having me, guys, and I'll just kickstart the presentation. So, as mentioned, my name is Onar Serrano from a company called Lendary. We are essentially lending specialists, also known as mortgage brokers. And just like any other presentation that I have to do when it involves any financial information, I have to present a disclaimer stating that anything you see here is of general information only and does not apply to you guys specifically. And if it is something that you guys would like to apply, obviously see a specialist or a accredited credit representative or mortgage broker. So just a little bit about us. Of course, qualified lending specialist. I myself both have the certificate and diploma of mortgage broking, which are required to be a mortgage broker. I also am a degree qualified bachelor from UTS, Bachelor of Business with Economics and Finance as my majors. Experience, our office has a total combined experience of about 20 years in the finance and mortgage broking industry. I used to actually be a financial planner or training to be a financial planner prior to becoming a mortgage broker. Between our team, we've got more than 20 properties combined. So in terms of owning property, knowing what to do with property, you could say that we can tick that off as well. We're focused on results. So you can obviously see the awards there. Our business has just been trading over a little bit over 3 years. And we've been nominated for some quite prestigious awards. Most recently, the Fast Brokerages, which is essentially top brokerages in the country that's been, labeled as a fast growth mortgage broking office. And just recently, last week, we were nominated for the best new office for the Better Business Awards. I'm also in the trenches with everybody else as well. So other than owning a mortgage broking business, you would know that I also own a couple of franchise gyms myself. So in terms of me getting a home loan, it's quite complex for me as well. So I also have an international business that master franchises a fitness brand as well. So as you can imagine, for me, going for a loan is not a walk in the park. In fact, my loan took more than 3 months to get approved, and that's me doing it as well. So in terms of understanding business structures, self-employed, sole traders, trust, fixed unit trust, and so on, I'm definitely in the trenches with everybody else when we're doing loan applications for clients. So just a little bit about our team. That's our team there. I'm not going to spend too much time on it. We've just added another person, so we've now 9 in our team. So we've essentially got 3 mortgage brokers, a credit analyst, a lending specialist, a lending associate, and our support team as well. So some of the services that we provide, we obviously do owner-occupied investment loans. We do equity withdrawal, construction loans, debt consolidation. We do professional and medical loans, meaning that a lot of clients that fall in that space do get away with quite a few things. We just did a loan for an individual, 95% no lender's mortgage insurance. And if anyone tells you that, it's near impossible unless you're a first home buyer. So we do guarantor loans and self-managed super fund loans as well. So just a little bit of overview of what I'll be talking about today. The 3 key takeaways is really how do you maximize your income to get a loan? How can you leverage your home loan to mitigate business risk? and working with your accountant and things you should know and discuss with them basically when you're prepping yourself to go for a purchase of a property. So firstly, to kind of understand all those points, I have to dive into how borrowing capacity works. At the end of this, I've done this as, I've simplified this as much as I can, and hopefully at the end of this, you guys can be qualified mortgage brokers and write your loan after this. So we'll see how we go. If you can't, then I did a poor job, and if you can, then hopefully you guys learned something there. Before that too, so I get clients that always call me and say, hey, I've got this much in my bank account, I should be able to borrow more. So there's a couple of client assumptions here. Some people think the more you've got in your bank account, the more you can borrow, which is actually false. Your borrowing capacity is purely based on your income and your expenses, which includes your liability. Clients call me and says, oh, I've been with the banks for 20 years, I should be able to borrow more. Unfortunately, that is not the case. You and I are just numbers to the bank. So it doesn't give us any special privileges in terms of how much you can borrow. I make good money and I should be able to borrow more. What is good, essentially? Some clients will say good has a different perspective of what good is. Some clients might have increased their income by about 15% and they'll call that good. But the borrowing capacity in general has been reduced by 20%. So you've actually gone backwards. So my rent covers my repayments. I should be able to borrow more. Slightly false there, because the way the banks assess your repayments, they actually inflate it, and the way they assess your rental income, they actually deflate it. So which means that often when you buy a property, your borrowing capacity is actually reduced. So irrespective if your rent actually covers the repayments. So the formula to understanding how borrowing capacity works the same way for every single bank. Every bank just has it slightly tweaked or visually looks different. Some banks have Excel spreadsheets. Some banks have an actual online portal where you log in. But essentially, it's the same key information that you would enter in if you wanted to manually work out how your borrowing capacity is. You probably shouldn't, because there's actually calculators online that you could just go on. On my website, you've got a calculator saying how much I can borrow. So just click on that and start entering it on details, and it gives you a rough estimate. But essentially, if you wanted to understand how much you can borrow, irrespective if you're a salary employee or a business owner, it operates the same way. So firstly, how the banks look at it is they look at your net income. Your net income, when I'm referring to your net income, if you earn $120,000 as your salary, that's not your net income. That's your gross income. Your net income is after tax. Similar for a self-employed individual, sole trader, if you had earned maybe $300,000 in sales, but your I guess what you call your taxable or your profit was say $100,000, that becomes your net income, not the $300,000. I get clients all the time saying, I did really good sales, I should be able to borrow more. But then you look at the final number, and then it's essentially the income is negative in most cases, to be honest. So you then add your rental income. So you got your net income if you earn 100 grand, then you got your rental income. If your rental income is $500 a week, the bank will desensitize that to 80%. So meaning they'll only look at $400 of your rental income. Then they minus out living expenses. HEM versus declared. What does that mean? Declared is what you declare as your living expenses. So you'd fill out a form and just say, I own this, I spend this much. And HEM is what we call a household expenditure measure. It's a estimated living expense that the banks have for you based on your income. The more you earn, the more they think you spend. And if your declared expenses is below their estimate, then they'll use theirs, which is often higher. So then they'll deduct any monthly home loan repayments on any existing home loans. So if you've got a home loan right now and you've got a $500,000 loan, but your repayments is based on, say, a 4.5% interest rate, the banks will always add a 3% buffer on that. So in fact, they'll look at the repayments at, say, 6.5%, or 4.5%, 7.5% interest rate, even though your actual repayments is much less. So again, it's inflating the repayments on that loan. Then they deduct any personal debt, so credit cards, personal loans, car loans, your HEX. The HEX is always often forgotten by clients of mine. If you've got a credit card, the bank will put a 3.8% estimate on that. So if you've got a $10,000 credit card, they'll look at $380 as a deduction against your net income, even though you don't use a credit card. So I got a lot of clients that have like those Latitude cards where they use it for overseas and they've got $20,000 credit card limits. The bank will deduct $760 out of your net income, even though you don't use that credit card. Then the loan that you're applying for. If you're applying for a loan, yes, GE, that's Yelp. If you're applying for a loan of say $800,000 and the rate is 5%, they'll add 3% and they'll look at the repayments at an 8% interest rate, which is quite high. The 3% add-on, it's actually an ASIC or a government requirement for us or the banks, so that if the interest rates were to go up, can you maintain the repayments? So interest rates have gone up 3.1% since I believe April. So it's at 3% on top of that as well. So again, they're inflating your repayments there. Essentially, if you are a positive number, you pass the calculator. If you're a negative number, you fail to calculate. This is a monthly cash flow analysis on the way the banks do their formula, and it's pretty much the same across the board. So we're just going to quickly apply this so you better understand this so you better understand it in the future slides. So yep, just net income, emphasizing it there. So we had a client, let's just call her Jane Simple, just a simple scenario. She's buying a property to live in. She earned $118,000 as a gross income, which is a $7,339 net income after tax, what you take home. She doesn't have any other loans, so that's zero. She declared a living expense monthly of $1,820, and the bank says, no, we think it's higher. It's $2,286. So they've used a higher. She has no other, loan repayments there. She had a credit card of $5,000 at 3.8%. The bank will just deduct $190 out of it, even though she doesn't use the credit card. The loan she applied for was $700,000. The rate at the time is 4.24. They added a 3% buffer, and they ended up assessing the repayments at based on 7.24. Therefore, the home loan repayments ended up being $4,770. So when you plus and minus all that, she was positive $93, and essentially she passed the calculator. This situation is actually really funny because she went for another bank and she got declined because she didn't pass the calculator, and she saw us and we found the right policy for her. So that's essentially how borrowing capacity works. Now we're going to go and apply it to self-employed clients. And it's probably where you guys would probably be really interested in and want to see how that would work. So in the future, when you run your business, or as you scale your business, I guess you could say, you can better understand how you would, future plan your numbers. So basically applying this to self-employed individuals. So there's obviously common structures for self-employed. I'm not sure if anyone's gone through it earlier. So there's sole traders, which is basically just an individual under your name, and you just get an ABN. You've got your partnerships. You can have a maximum of 20 individuals under a partnership, I believe. Maybe Lewis can confirm that. Company, which is a separate entity of itself and often requires a director and shareholders as well. There's actually a fourth one, which is the trust structures, where it's a discretionary trust, a fixed unit trust. But often we get more company applicants than we do trust applicants. So the overarching requirements for self-employed individuals. So when you're looking to submit a home loan, we're talking about maybe the major banks and your second-tier banks like your Macquarie, your Suncorp, your ING. There's an overarching set of policies. Every bank has a slightly tweaked policy for their requirements, but there is a standard requirements that would usually apply for most of them. So often you need to have an ABN registered of about 18 to 24 months, preferably GST registration. GST registration basically means that you're turning over $75,000 or more, which obviously emphasizes that there could be potentially higher income. The banks usually take the average of the last 2 years of your profits or your taxable income or your financials. So if you earn 100 grand, 200 grand, they'll basically average that out to 150 grand, and they won't look at your 200 grand. However, 1 year financials do exist. So the banks like ANZ as an example, Bank West, if your most recent financials is stronger, they'll look at the most recent financials. Obviously, with COVID, a lot of people's financials in the 20s and even 21s weren't as great because their trade was halted. Like one of our gyms, or two of our gyms, was basically stopped and was not allowed to trade for 4.5 months. We lost quite a bit of revenue on that. I think it was over 200,000 each gym. So obviously the most recent financial for us, which would be the 2022s that just passed, would be the strongest. So you can go to lenders that do and look at 1 year financials. There's lenders out there that will just look at your salary as well. So if your financials aren't amazing, but you've been paying yourself consistently, you can present those salaries that you've been paying through your individual tax returns, and they'll allow you to get away with that and use that as well. There's also what we call salary payment credits. So if, again, your financials hasn't been great due to COVID or anything else that's been affecting your business, and you have paid yourself consistently, say for 6 months, the same wage goes into your bank account for 6 months, and supported by an accountant's letter to confirm that the business is trading profitable, you can actually use that. That is probably the easiest one, and that's a fairly new policy that's just been released by a couple of banks, namely CBA. So, net profit and taxable income. Just remember, we're looking at net profit, not your sales or your revenue, because we have to deduct all the expenses around it, and it's basically your net taxable or possibly your take-home income. So, the incomes that you can use as a self-employed, you can obviously use your net profit. If your company's made a net profit of 150 grand, you can use, of course, you can tell the bank, well, if I wanted to, I can take out that 150 grand and pay myself, and then that would become part of your income. The salary you pay yourself. So like myself, I pay myself a wage through the company. So it's a consistent wage that I get paid, and then I can use that. There's also dividends. Dividends is basically the distributions of profits to the individual. You just got to be careful with dividends. There's a slightly, restricted way of assessing dividends, because you might have a company that might be negative in profit, but issuing dividends, which in reality won't be sustainable. You can't keep on paying dividends if your company's making a loss. So you just got to be careful with that. There's add-backs, depreciation, interest, superannuations, and additional super. What does that mean? Depreciation is a non-cash flow expense. So if you, for instance, depreciated all your furniture in your office and they've allocated $50,000, you didn't actually depreciate $50,000. You didn't actually spend $50,000. You've just devalued $50,000 out of your furniture in your office. So you can actually add that back as a full 100%, add back. So, whoop. So when you're using company profits, as mentioned, you've got the company profits, the salary, the dividends. When you're using company profits, you have to make sure that you're going to the right bank when you're utilizing company profits. So if you've got a company, but it's got a car loan, a credit card, and unsecured lending, and you're going to use the profits of, say, 100 grand, but the total expenses for all those liabilities is, say, 110 grand, if you go to the right bank, you might be able to get away on not having to add those liabilities. Yeah, so I've got a client who owns a pretty big steel manufacturing business. They've got 15 car loans, they've got unsecured lending, an overdraft, and if you add all that back and then add in the profits of the company on the calculator, it actually is a negative. So we went to a lender that does not require the add back of the liabilities. So in this example, ANZ requires you to add all the liabilities in if you're using the company profits, if the company has liabilities, but Westpac doesn't. They'll just take the net profit of the company and then they'll ignore the liabilities of the business. This is great when you've got a lot of liabilities or you've got a significant, say, overdraft that you don't actually use, but it's going to go against you in terms of your borrowing capacity. When using your salary only, so you can actually just use the salary. We don't have to use the company profits, because company profits, like that client of mine who has 15 car loans, 5 overdrafts and whatever, for him to do a loan, he has to get all those statements, but he already passes the calculator just with his salary. So he just used his salary and we didn't have to use any of the company profits for him to pass the calculator. So he didn't have to collect any of the documents for those liabilities. And also meant that we didn't have to add in the liabilities on the calculator. Yeah, when I'm referring to the calculator, it's that formula that we looked at earlier. Basically, they remove the whole liability section. Percentage of ownership matters. So we're doing a loan right now for a client who owns 24%, 24%, 24%, and the remaining to another individual. But a bank that is approving, or we're looking at submitting their loan, needs to have every shareholder to have 25% or less. Yeah, so you've got to look at your shareholding percentages, and you've got to make sure you get to the right bank that allows the percentage of ownerships, because there's people that own maybe 10% of a business and they want to utilize the company profits. So you just got to be careful when how you structure your ownership. Of course, full ownership of the company is better than obviously a piece of the pie. So here's an example for you. So this client of mine owned 100% of the company. His company profits were 100 grand, and he paid himself a wage of $50,000 for that financial year. I think this might have been 2020. He had a car loan under the business, and that car loan was $50,000, and it was a $600 repayment per month. So we looked at Lender Red, just labeling these colors, you can probably make out which banks they are. Lender Red accepted the $100,000 and $50,000 and did not consider the liability of the $50,000. Lender Blue looked at the $100,000 income, the $50,000 salary, but had to expense the $600 car loan repayment. So imagine you're going for a loan and you're just passing the calculator by $599, and Lender Blue says, oh, well, we've got to add in the $600 repayment. You're now failing that calculator. So that's when you need to utilize the right bank, and you go to Lender Red in this scenario. So another overarching policy is, again, when you look at your income, so the banks often do the average of the 2 years, unless you're doing 1 year financials. When the newest financial year is lower, they'll use the newest financial year. So if you made 100 grand previous year and you made 50 grand this year, they're not going to take the 100 grand. They're going to take the newest one, because that's the most recent financials. Yeah. And then there's also the most recent financial only, meaning the 1 year financials. Just be careful. There's your variance, your profit hasn't changed by more than 20%. So Bank Rest is an example. If you go up by 20%, so you go from 50 grand profit to 100 grand profit the following year, you basically got to explain why the variance is more than 20%. And then there's what you call the true most 1 year financials. ANZ is probably the best at this in the space. They will purely just look at the most recent financial. They wouldn't even care about what happened in prior years. So, and then there's a salary-based only, which CBA, if I paid myself 6 months, I just go to CBA and just show them my 6 months salary credits that I've been paying myself consistently. So just make sure you know what lender you're looking at. That's it. So when you look at your scenario, we look at your scenario and we basically say, okay, well, this is the income, this is the salary, and these are your liabilities. You're best to go to this bank for such and such a reason. So I've given an example here of what I mean about the way they assess their income. So we looked at company liabilities earlier, how it doesn't get expensed, and it does get expensed. I'm going to show you how it makes a massive difference of going to the right lender when your financials are different from previous years. So client of mine, 100% ownership. The profit in year one was $50,000, and profit in year two was $100,000, and they paid themselves 50 grand salary. Whoop. So Lender Red averages the 2 years. So they looked at $75,000 as an average, average of $75,000 for the financial years. So 150 plus 100 divided by 2, and then they looked at his salary of 50 grand. So they looked at his income at $125,000. Yeah. Lender Blue, they looked at the most recent financials. So they only looked at 100 grand plus the salary. Therefore, they're using his income at 150 grand, which is $25,000 more. Lender Green, we only used the salary. They only looked at 50 grand. So it matters where you're going. So imagine you're going for a loan and you went to Lender Green, and Lender Green says, well, we're only using 50 grand. Your borrowing capacity has been severely cut here, where I can go to Lender Blue and ×3 your borrowing capacity. So these are real important strategies that you got to consider when going for a home loan, when you're self-employed, and utilizing the right policy when you're looking at applying for a loan. So more examples. So this is a real life scenario. So Jane Doe, single individual, owns a business. She's been operating for 26 months. So she ticks the box for the 18 to 24 months. She had 2 financial years of trade. She had a net profit of $30,000, $60,000, and paid herself a salary of $90,000 both years. And then she had a $5,000 credit card. And yes, I agree with you, Cheryl. And she wants to buy a property for $1 million. She has a 20% deposit, and essentially she's going to borrow an $800,000 loan. So the rate that was quoted for her was 4.7 at the time, and she went to see 2 banks. She actually went to see both of them, and she ended up seeing us anyway. So Lender Red and Lender Blue, and this is what happened. Lender Red averages the 2 years of her financials. So they look at the 90,000 plus the 10,000. Sorry, they took the average of the 2 years. Basically, she ended up being less. She had no rental income. She was buying an owner occupied. That's better. 90,000 and 30,000. So net profit was averaged essentially. And then the HEM 2,286. I left the same number. She had no existing home loans. She had a $5,000 credit card, which they expense $190. So you guys should be really good at this calculator now. It has this formula. So you should be doing this with your eyes closed now. The loan of $800,000, the rate was 4.9, sorry, not 4.7. And then the bank adds 3%. They looked at the repayments at 7.9%, which is 5,814. She basically failed this calculator. She was negative 951. She then saw Lender Blue. She then actually ended up seeing us through Lender Blue. Because she didn't feel comfortable because the outcome actually ended up being better for her, but she wasn't sure why. So we took her through the journey, and she understood at the end of it why she was able to go to Lender Blue. So Lender Blue took $90,000 of salary and the higher most recent financial year of $60,000. That ended up being a net income of 8,864. She's got no existing rental income. We just made the average of the HEM the same. Each bank have different HEMs, but for this exercise, we just left it the same. No existing loan repayments. The same credit card applied, $190. The loan repayment is the same. And this instance, she passed the calculator by $574. So imagine you walked into Lender Red. You didn't know how self-employed work. You get declined. Most people actually think that's it. They're not going to be able to get this, and they just stop there. So, and also that feeling of getting declined on your first application is actually pretty horrible. So, well, it's not ticking. Sorry, guys, I just can't move to the next slide for some reason. Oh, there you go. Cool. So that's basically the different overarching policies that you need to watch out for self-employed. Obviously, there's a lot of detail in there. And at the end of it, I mean, I don't expect you guys to kind of work out your own servicing calculators, but to understand if you're using the most recent financial year or the average of 2 or just salary, it really helps. And there is actually more. Sorry, guys. Sorry, guys, my slides just disappeared. Yeah, it's back. Cool. So we're gonna look at business risk and how you can use, I guess you can use the equity in your property to mitigate business risk. And this is an example that I'm gonna actually apply to what happened to me and a few other friends of mine that own some franchise gyms. Obviously during COVID it was a bit tough. So business is a game of monthly cash flows. However you put it, I mean, to simplify it from my financial perspective, I mean, obviously there's marketing, there's sales, and there's a whole bunch of other stuff, but if you just really just bring it down to its core and most important thing for me anyway, from the finance side of things, it's a game of monthly cash flows. It's just making sure your sales and your expenses and your finance repayments are being met. And then at the very end, you've essentially got a profit around it. Oh, no. So this is what I mean about a monthly cash flow.
Nathan,
yes.
Yeah, sorry, brother. Is there any way that people can access this information? We just ran out of time, unfortunately. Are we able to access this information sort of on your website or getting a consultation with you?
Yeah, no problem. So what I can do is I can send this to the team, and essentially you guys can send it out, or if my details are at the back of this, and they can reach out to me. So
fantastic. Well. Sorry to cut you off there. There was so many calculations, and a lot of people in the chat. Marjorie was saying she thought it was very helpful, and that's certainly someone like me. It was all just like, whoa, like you really broke it down so well. So thank you so much for joining us today and bringing your insights. It was fantastic.
That's all right. No problem. That's all good.
Cheers.